Good morning, everybody. Thank you for the introduction. My name is Alison Coughlin. I have been with the exchange for about 9 years now, covering lumber for 7 of those years. As the introduction said, part of my job is coming up with new futures and options contracts. So the new lumber futures contract that was launched in August, I wrote the rule book and the contract specifications for that. So any compliments, come to me. And this is my colleague, Tom. He's going to do the second sort of half of our bit of the presentation. And he's on our business line management team covering lumber. This is just our generic disclaimer. We are not giving trading advice. Please do not take this as trading advice. I have never been a trader. I will never be a trader. I'm just here to educate you on sort of the basics of what the futures market is. So this is our very brief agenda. And like I said, this is going to be a Futures 101. Very basic, but we're happy to take questions at the end. But I know futures can be kind of a complex topic. Everyone sort of knows what we're talking about, but maybe not all of the details and definitions and things like that. So we're here to cover that. But really what I want you to walk away with after this presentation is understanding what a futures contract is, understanding how you can use them to manage your price risk, and understanding how the growth in our new LBR lumber contract can help your business. So first, I'm going to start with a very brief definition of futures. It is simply a legally binding agreement or contract to buy or sell a standardized quality and quantity of a product at a standardized time. So 27,500 board feet for the new LBR contract, 2x4, number 2 and better, random lengths, a specific tally. That is all written into the futures contract, and there are expirations every other month, and that is the standardized time at which you can participate in delivery. And sort of the origin of futures, which I think helps people understand this, is, you have to forgive me, I also cover grains and oilseeds, so I'm going to use a Board of Trade example as opposed to a Merck example. But back in the mid-1800s, there was no centralized location for price discovery in the grain space. There were merchants and there were sellers and buyers, but they weren't all coming together, and so there was no way for everyone participating to know what the actual commodity price of a product was. So people got together and said, everyone come to this one location, and anytime corn, for example, is bought or sold, anytime a transaction happens, we're going to write it on a chalkboard so everyone can see what the price of a commodity is. And that was the origin of futures. So that has developed into then forward contracts, which developed into futures contracts, and really futures serves 2 main purposes. The third, we're not going to get into, efficient commodity allocation, but if you're interested, find me. I will talk your ear off about it. It's fascinating, but not as applicable to lumber. So we're just going to focus really on the first 2, which is price discovery and price risk management. So like I said, the origin of futures was really discovering what the price of a product is. It's a centralized place for everyone, for buyers and sellers to come together, put bids and offers together, and everyone can see what the market rate, what the market price of a commodity is. This benefit is actually conferred to the public, right? CME Group, anyone can go on cmegroup.com/LBR and find what the current futures price, slightly delayed, what the futures price of lumber is, not just for this month, but for deferred months as well. So you can be making educated decisions based on what the market is saying the price of lumber is, what buyers and sellers have mutually agreed to, essentially what the price of lumber is. The second is price risk management. The way this works is because cash and futures are, or should be, but are highly correlated, which means they don't always have to be the same price, but the price movements are reflective of each other. If there's an increase in the cash market, there's an increase in the futures market. Conversely, if there's a decrease in cash, there should be a decrease in futures. So because these markets are highly correlated, you can use the futures market to effectively lock in a price for a commodity and manage your cash exposure. Because the concept is that any loss in the cash market is offset by a gain in futures and vice versa. It is not a money-making, hedging is not a money-making endeavor. You should, if you are hedging properly, it is not a gain in cash and a gain in futures or two losses. It is a way to offset your cash exposure. When I started at CME, one of the first things someone said to me was, if you have physical exposure and you're not hedging, you are a speculator. You are taking all of your price risk and putting it in the cash market as opposed to laying it off within futures. So I know that lumber tends to use the futures market as another avenue of sales or procurement, which is valid, completely fine. But one of the things I want you to take away today is it can also be a financial tool. We have developed this new contract. We talked a lot about physical delivery and what that looks like, but you can hedge and never think about physical delivery. You can roll your position. You can merely use it as a financial way to mitigate adverse price movements in the cash market. Also, yes, our contract is 2x4, SPF, Doug fir, and hem fir, but any lumber 2x6 or another species that is highly correlated with the futures price, that inventory can also be hedged using our contract. Exchange delivery is rare, it has to work, but it is a financial instrument for the industry to use to help offset or mitigate any risks, cash price risks that you're facing. Obviously, we're here to answer questions afterwards, and we are presenting with two of the brokers in the market, but we are always here to answer your questions. No question is dumb. The futures market can be complicated, so we're always here to answer your questions as well as brokers. And with that, I'm gonna turn it over to my colleague Tom to talk a little bit about what our new contract, new LBR contract looks like, and sort of how it has grown since its inception in August.
Awesome. Well, thank you very much, Alison. It's great to be here, and I appreciate the time you're giving us to speak to all of you today. Just a little bit more background on myself. I've been with the exchange for the last 6 years, holding various positions on the agricultural business line team as the lead business analyst across all of our agricultural products, so everything from corn and soybeans and live cattle to having the opportunity to help shepherd lumber futures and options through historic volatility we've seen over the last couple of years. So I'm going to talk to you a little bit today about some of the changes we've made to our new lumber futures and options contract, as well as some of the growth that we've seen since we launched this new contract on August 8th of last year. And just keep in mind that this new contract will be replacing the legacy lumber contract with that has a last trade date of May 15th this year, so coming up in a couple weeks. So a lot has changed in the lumber market over the last few years, and this prompted us to take a really hard look at what we were currently offering in our existing lumber legacy contract. So after a lot of industry feedback, we made a number of enhancements to the contract that we think help reflect and allow for more robust participation all around. So I've highlighted the main enhancements we've made to the contract here in red, but there are two I really want to focus on because those are the two most fundamental changes to the contract. The first being the delivery location. So this new LBR contract is a delivered Chicago contract, which opens up participation to both the East and West Coast, allowing for a more robust participant base to transact in this contract. The second being the size of the contract. This new contract is, as Alison mentioned, 27,500 board feet, which is equivalent to roughly one truck. This opens it up to more precise risk management strategies, as well as opens it up to participants that historically have not been able to participate in the contract due to its size, the old contract size being 110,000 board feet. So those are the two main changes that we wanted to highlight. There are more, so if you have questions on any of these at all, please don't hesitate to ask, and we're happy to answer your questions. So how's the new contract been growing? Very well. So we keep in mind this is still a very new contract, but the growth that we're seeing it makes us very excited about the future potential growth of this contract as a whole. We currently have around 400 contracts traded per day. We're consistently setting volume and open interest records, which is a clear indication to us that adoption is occurring in this new contract, and customers are coming to trade it, and liquidity is building. And when I say liquidity, I more mean that in a sense of the ease of execution to transact in this contract. Open interest, right now it says September, but we actually, as of today, have open interest out to the November 2023 contract. On a notional basis, we're currently trading around $4 million a day or 7.5 million board feet of lumber per day. Again, this is still growing, and we're seeing growth, the trajectory around 60% month over month, which is super exciting for us and for the industry as we continue to build this product. You can primarily trade this on CME Globex, which is our electronic trading platform, but we also have alternative execution methods. If there's not enough liquidity in the order book or you want to transact in an illiquid month, you can do what we call a block or a cross, which is just an alternative to executing via the screen, and happy to answer questions on that as well. So how has this been performing relative to the legacy contract? Again, very well. So as you can see, the chart on the left shows the open interest, the open contracts in the legacy LBS contract versus the new LBR contract. As you can see, on a per contract basis, we are now trading well over what we are in the legacy contract, which is also very exciting to us and to the industry that we see that adoption is occurring for this new contract, and this looks to be a viable opportunity for participants in this market to transact. The other thing I wanted to highlight in the chart on the right is something we look at to sort of determine the health of a market and determine the overall cost to trade for the end customer. Something that we're seeing is that the cost to trade in this new contract is far cheaper than it has ever been in the legacy contract. Now, this is just a screenshot of one day, but we're starting to see this on a more consistent basis, which is great to see from a new product standpoint, as well as this market continues to develop. We expect liquidity to build and it to be relatively a cheap risk management strategy for participants in this market. So that's just a brief overview of some of the trends we're seeing, some of the main changes we made in the contract. Hopefully this was informative. You learned a little bit about what futures are, how they can help your business manage risk, and some of the growth we're seeing in this new contract. And we're here to answer any questions you have. So thank you.